Assalamualaikum. My name is Nukman Shabil, and today I will breaking down a final exam question, July 2025. Question 1 about speculating. And look at the question. We have Mr. Ali, a speculator who believes palm oil prices are about to drop. Because he's bearish, he decided to go short, selling 8 FCPO contracts at 4,185 ringgit per contract. Before he starts trading, his broker requires an initial margin of 10,000 ringgit per contract and a maintenance margin of 8,000 ringgit per contract. And our job is to build a 5-day mark to market report and see exactly what happens to his money day by day. Before we jump into the daily tracking, we need to calculate first our total financial boundaries. Because Mr. Ali is trading 8 contracts, we multiply the per contract requirement by 8. So the first one is total initial margin is 10,000 ringgit times 8, which is equal to 80,000 ringgit, and maintenance margin, the total is 8,000 ringgit times 8, we get 64,000 ringgit. And as long as Mr. Ali account stay above 64,000 ringgit, he's safe. If it drops below that, he gets a margin call. Let's see how he fares over 5 days. Now, let's look at the mark-to-market table from the question. Remember, because Mr. Ali is shorting, he makes money when the prices go down and loses money when the price goes up. For FCPO, each point movement is worth 25 ringgit. On day 0, we start with entry price of 4,185. No profit or loss yet. The account starts at our initial margin of 80,000 ringgit. On day 1, the prices drop to 4,181. That's a drop of 4 points with using formula as follows. And by using the formula, we get plus 800 ringgit and makes his account balance rises to 80,000 ringgit, 80,800 ringgit. On day 2, the price dropped further to 4,174, another 7-point drop, and the profit is plus 1,400 ringgit. This pushes his margin balance up to 82,000 ringgit to 82,200 ringgit. On day 3, the market moves against him. The price ticks up to 4,178. That's a 4-point increase, leading to a loss of 800 ringgit. Balance drops to 81,400 ringgit. On day 4, a bigger jump to 4,186 means an 8-point loss, costing him 1,600 ringgit. His balance dips to 79,800 ringgit. Note that this is still well above his maintenance limit of 64,000 ringgit. Day 5 and the last day, the price drops back to 4,180, giving him a gain of 1,200, leaving his final variable margin balance at 81,000 ringgit. Now, let's answer part 2. What is his net profit or loss if he decides to close out his position on day 4? To find this, we simply look at his current margin balance on day 4 and compare it to the initial amount of money he put into the account. From our table, in his day 4 margin balance is 79,800 ringgit. Subtracting his initial deposit of 80,000 ringgit, we get minus or negative 200 ringgit. So if Mr. Ali exits the market on day 4, he walks away with a minor net loss of 200 ringgit. Finally, let's address the part B from the question. If Mr. Ali holds this contract until expiry, he would legally be obligated to physically deliver tons of crude palm oil. Since he is a financial speculator, he has zero interest in handling actual physical oil. To avoid this, he must execute an offsetting buy transaction in the open market before the maturity date. Since he initially sold short, he must buy long. This offsetting trade perfectly cancels out his open obligations with the clearinghouse dropping his net contract balance to zero and allowing him to settle his position purely in cash.
Assalamualaikum and good morning. My name is Wan Asma Alia. Today I will explain an interest rate arbitrage opportunity involving the FKB3 futures contract, which is July 2025, and the CLIBOR market rates. The objective is to determine whether the futures contract is overpriced or underpriced, and whether we can generate a risk-free arbitrage profit. Firstly, the information provided is FKB3 futures price 93.5, CLIBOR 60 days 3%, CLIBOR 150 days 4.5%, conversion rate after 60 days 5%, and principal amount of 5 million. We will use these values throughout the calculations. The first step is implied futures rate. First, I will calculate the implied futures interest rate. I use the formula of futures rate equal to 100 minus futures price. So, 100 minus 93.5 equal to 6.5%. This formula is used because interest rate futures like FKB3 are quoted in price format, not interest rate format. So, we convert it into to compare with CLIBOR rates. Step 2, I will imply forward rate. Next, we calculate the implied forward rate, which is IFR, to find the fair market interest rate. Next, I will calculate the IFR. Firstly, 1 plus 0.045 times to 150 and divide to 360, and then divide again to 1 plus 0.03 times to 60 over 360, and then we minus with 1. And then we times to 360 divide to 90, so we will get the answer is 5.47%. This formula is used because we are constructing a synthetic 90-day forward rate from two spot rate, 60-day and 150-day CLIBOR. Step 3, we calculate fair futures value. Now, fair value equal to 100 minus IFR. So, 100 minus 5.47 equal to 94.53. This converts the forward interest rate back into futures price format so we can compare with the market price. Conclude for step 3, market future price is 93.5. Theoretical fair value is 94.53. Since the 94.53 greater than 93.5, the futures is underpriced. So, we will buy futures, which is long position, and expect price to rise to fair value. For cash market, borrow 5 million for 150 days at 4.5% and lend RM 5 million for 60 days at 3%, and after 60 days roll over at 5% for 90 days. So the reason is we lock borrowing costs for full 150 days and earn interest in parts to matching timing. For the futures market, buy FKB3 at 93.5 and expect price to rise to 95. Why we got 95? Because 100 minus to 5 because the conversion percent is 5%. Next, in the cash market, the dealer borrows 5 million for 150 days at 4.5%, resulting in an interest payment of 93,750. The money is then invested for 60 days at 3%, earning 25,000 and roll over for another 90 days at the convergence rate of 5%, earning an additional 62,812.50. Therefore, the cash market records a net loss of 5,937.50. In the futures market, the price increased from 93.5 to 95, giving a profit of 18,750 for 5 contracts. After offsetting the cash market loss, the dealer earned a net arbitrage profit of RM 12,812.50. This confirms that the FKB3 contract is underpriced, so the correct arbitrage strategy is to go long on the futures contracts. For question B, FKB3 is used by financial institutions to hedge against interest rate risk. If interest rates are expected to increase, they short the futures contract. If interest rates are expected to decrease, they will go long. This is because FKB3 and CLIBOR have an inverse relationship where futures price equal to 100 minus interest rate, helping institutions reduce risk and stabilize future cash flow.
Hello everyone, my name is Nurina Suha binti Nur Azman. So today I'm going to walk you through question 3. and show you how to do hedging calculation. So, based on the question, can you imagine that you are managing a big stock fund in Malaysia worth 12.8 million ringgit? The economy is looking bad and you are worried the market is going to crash. Because your portfolio is mixed well, its beta is 0.8, which just means it moves a bit slower than the main market. So right now, the actual stock market index is at 1580, but the 3-month FKLI futures contract is selling at 1585. We want to protect 90% of our fund for the next 90 days. So let's look at how we set this up. To protect ourselves from falling prices, we do what's called a short hedge. We split our actions into two sides, the cash market, which are our actual stocks, and also the futures market. So the first step is we need to find the number of contracts. So to find out exactly how many contracts to sell, we use a straightforward formula, which is portfolio value times H ratio times beta divide by futures price and also times RM50 ringgit for the multiplier. When we plug in our numbers, then we will do 12.8 million times 0.90 times 0.8 divided by the futures price, which is 1585 times the standard multiplier, RM50 ringgit, and then we will get 116 contracts. So that is our number of contracts. In the cash market, we just hold on to our 12.8 million ringgit portfolio. But in the futures market, we open a safety net by selling FKLI contracts at 1585. Now, what happened after 90 days? Let's fast forward 90 days after. The market drops exactly like we feared. The stock index falls to 1500 and the futures price dropped to 1500 as well. So let's look at the math for both sides. First, our futures position. Remember, we sold high at 1585. So now the price is low at 1500. We buy back those 116 contracts to close the deal. Because the price dropped by 85 points, we made a clean profit of positive 493,000 ringgit. And the second one, our cash position. Since the stock market fell, our actual stock lost value because of our 0.8 beta. Our portfolio dropped by a calculated loss of negative 648,101 ringgit and 27 cents. So after all this step we took, what is the final result? If we did nothing, we would have lost over 648,000 ringgit. But because we hedged, we combined both sides. Yes, we lost 648,101 ringgit and 27 cents on our real stock, but still we made 493,000 ringgit from our future contracts. When you put them together, our net loss is only 155,101 ringgit and 27 cents. So the strategy worked perfectly. And to wrap things up, this is exactly how portfolio manager use FKLI contracts to handle the market up and down. When we think the market will go down, then we do short hedge. If we think the market will go up, we choose long hedge. Now, let's look at question D and talk about how portfolio managers use FKLI futures to handle both ups and downs of the Malaysian stock market. So it basically comes down to two simple strategies. The first one, when we expect the market to go down, we use a short hedge. This is exactly what we just did on our calculations. We sell futures contract so that if the market crash, our futures profit can cover the losses on our actual stock. Second, when we expect the market to go up, we use a long hedge. Imagine you are waiting for a large cash inflow to buy stocks on the next month, but you are worried that the market will get too expensive before your monies arrive. So, to fix that, you can buy futures contracts today. If the market jumps, the profit you make from your future contract will offset the higher cost of buying the physical stocks later. By using these two tools, we can keep our portfolio stable and protected. That's all. Thank you.
Now, let's have a look at question 4, which is a question about spreading. First, we will identify the product. Here, the product is FMG5, which is the futures product for MGS. Based on this question, this is about an intermonth spread. Before jumping into our calculation, let's keep in mind where the contract multiplier of MGS futures is 1,000 ringgit per 1 full point move. Here, the strategy is to buy December 2025 FMG5 and sell September 2025 FMG5 because it's stated in the question that we are expecting the interest rate to fall, therefore futures price will rise. Then it means that we will gain profit if the closing price is higher than the opening price. Then we proceed to make our table just like the example from the book at page 145. Today, we sell the September 2095 FMG5 at 105 ringgit and 20 cent, and then we buy December 2095 FMG5 at 105 ringgit and 6 cent. The basis spread is 0.14 basis point, which is the difference between these two opening price. Later, at maturity, we buy September 2025 FMG5 at 110 ringgit 55 cent, and then we sell 2025 FMG5 at 113 ringgit and 90 cent. The basis spread is 3.35 basis point. Then we will calculate profit or loss of each contract using a formula. For short contract, we will subtract opening and closing price, then multiply with the number of contract and contract multiplier. For long contract, we will use the same formula, but we have to subtract closing price with opening price, and then multiply with number of contract and contract multiplier. At opening, we sell September, therefore it is a short contract, and we buy December, which is it is a long contract. So after the calculation, for September we get a loss of 53,500 ringgit. For December we get a profit of 88,400 ringgit. Since the question stated that there will be a commission fee of 100 ringgit per contract, we will calculate our total commission by multiplying the commission fee with our number of contract, which is 10. So the total commission will be 1,000 ringgit. Last but not least, we have to calculate net profit by subtracting net gain with the commission fee, because the commission fee is a fee that we have to pay. Therefore, The final answer will be 33,900 ringgit. Thank you. Investors can speculate the future interest rate movement by taking a long position when interest rates are expected to fall, and on the other hand, take short position when interest rates are expected to rise. This is because of the inverse relationship between interest rate and futures price.
Assalamualaikum and have a very good day everyone. My name is Nonadira binti Muhammad Nazri and I will present to you guys about past year question July 2025 FIN 549, which is question 5, chapters options. So the answer for the first question is we choose bull call spread, which is price expected to rise, so we choose bullish, and bullish plus limited profit and limited loss is bull call spread. So bull call spread is buy low call and sell high call. So we calculate the maximum profit and get 270, and the maximum loss is we get 30, and the break even price is we get 1350. And this is a graph that I've done for bull call spread. Second questions, and the answer is choose strategy who is profit while the price are not changing too much. So we choose short triangle, which is sell high call and sell low put, and then we do the calculation of the maximum profit and get 140, and the maximum loss is unlimited, and we calculate the break even price, which is strike price call plus total premium, and get 1760, and the break even price B is strike price put minus with total premium and get 1180. So this is the graph that I've done for the short triangle. Third answer is price expected to descend. So we choose bearish, and the limit the loss is spread. So we choose bear put spread, which is buy high put and sell low put. So the calculation of the maximum profit is we get 230, and the maximum loss is we get the 30, and the break even price is we get 1550. So this is the graph that I've done for the bear put spread. The fourth question, the answer is the high market volatility by both call and put, which is call strike price slightly higher. So the strategy that we choose is long triangle, which is buy high call, and buy low put, which is call strike is greater than put strike. So we get the unlimited profit, limited loss is 110, and the break even price there's two. And the first one is 1730, and the second one is 1470. Question asks for the index rise to 1690. We do the call option and get the 70, and then we do the profit call and we get the 20, and the total profit or loss we get the negative 40, which is still loss. So the put is price will rise greater than strike, and put will expire worthless. So the loss put is premium, which is still negative 60. So this is the graph that I've done. And the last question, which is the theory, which is what is short triangle? Short triangle is investor sell a call option with a higher strike price and sells a put option with a lower strike price, and both having the same expiration date. And the strategy is suitable when the investor expects the price of the underlying asset to remain relatively stable with low market volatility. So the potential reward is the maximum profit is limited to the total premium and received from selling both options. So the risk is the potential loss is unlimited if the price rises significantly above the call strike price, and the loss can also be substantial if the price falls sharply below the strike price.